think we met and we spoke about a few things concerning re-entry into the bond market. Today, we are back your way with a few market updates and also something on taking treasury positions in the US and in Ghana. Today, we have with us portfolio analyst with the Black Star team. He's going to be He's going to give us insights into what has happened so far on the Ghanaian market, from currency to taking from currency to dropping yields, and also he's going to take us into a few reasons why he thinks that we should be looking at taking treasury positions both locally and then abroad. Without saying much, I'll introduce Justice to take over from here. Thank you very much.
Hello, guys. Good morning. Hope you can hear me. Awesome. Good morning. Let me just welcome each and everyone to today's edition of the Market Scholar. My name is Justice. As Isaac mentioned, I'll be leading the conversation for this morning, where I'll be giving us a color on what's happened on the market over the past month, and then we'll sort of look at a new conversation where we'll look at the recent views on taking treasury positions here in Ghana and then outside of Ghana, because the conversation have been around looking at geographical diversification. So that is what our conversation will be around this morning. I'm hoping that today's conversation will be more of a discussion where we hear from the participants on the call as well, what their views have been on some of the key developments in the market. I think we are all players in the market. We have fund managers on the call. We have industry players on the call, trustees on the call. And I think it would be good if we all share our sentiments on some of the developments in our space. That will help us in some of the decisions we make that will transform our economy at large. And so coming into this particular presentation, one thing that have been on my mind is if it's a good time for us to assess the performance of this new administration, that's the John Mahama administration, just looking at the numbers so far. And I think some of you would agree with me that it's too early. We should wait for some time to actually digest the numbers very well, to see where they lie actually. Warren Buffett once said, and one of my bosses here at Blackstar would always say, quoting Warren Buffett, you only when the tides go down do you discover who has been swimming naked. And so for now, we cannot judge the Mahama administration based on what we've seen so far, but we have to wait to actually digest some of the numbers, look at the trend for a period to be able to see what they've done so far. And so moving away from that, let's jump into the market update, where we'll look at what's the state of the economy. And I'm sure we'd all be curious to know where we are at the moment. We've seen the administration come, new measures, new policies. It's been a good one for us. We've seen some key interventions, some key development on the space. But what are the macros looking like? So for our GDP growth, where are we at the moment? I placed a question here that says, will all three sectors see a balanced growth coming to the end of the year? What have we seen so far? We've seen Ghana's GDP continue on that positive trajectory. We've seen our economy expanded by 6.3% year on year in Q2 of 2025, which is actually showing us that we've seen one of the fastest growth since the third quarter of 2023. The question again will be, what have been some of the factors that are driving this growth? We've seen the services sector grow by a 9.9%. That was actually followed by the 21.3% we saw in the ICT sector. We still have high data usage issues being one of the key challenges the Ministry of Information and Communication is trying to address. And so we are hoping that the data prices will come down to actually improve data usage and ICT usage in our space. So we'll monitor that space as well. Then we see education also growing by 16.6%. We saw health and social work also growing by 14.6%. Other personal services also saw a growth of 11.3%. Finance and insurance also saw a growth of 9.74%. And so it's looking like everything is on a positive trajectory for the country. Agriculture we've seen a 5.2% growth in that sector as well. We are seeing a little contraction from the mining and quarry sector, which declined by 1.8%. We saw oil and gas also suffering in the course of last quarter, coming to this quarter by 22.5%. Looking at the demand side of the growth, we see growth was supported by the sharp increase in household consumption that went up by 12.2%. Government consumption also dropped by 0.2%, which we all know from the start of the year, they were anchored on trying to cut down consumptions and then their spendings on the market. Now we see Ghana recording growth across most of these sectors. That is why I mentioned, are we going to see a balanced growth coming to the end of the year, where we see the agricultural sector, we see the services sector, and then we see the industrial sector all having a balanced growth? Would that be the case? I think we'd have to monitor it to see what happens going forward into the future in this particular administration. Yes, now we cannot do away with inflation because we are actually trying to see what's the prices on the market. We are saying that economic variables are improving. Are we seeing that reflecting in the prices that we are seeing on the market? Is that a reality on the market when you are looking at how much you have to bring out of your pocket to buy food for the house, when you're looking at how much you spend on transportation? Are we seeing that's happening? Let's see what's happening here. So we are seeing inflation in terms of the trend. We've seen inflation go down significantly. Efforts from the Ministry of Finance, efforts from the Bank of Ghana, all anchoring to what we are seeing here. Now we have our inflation now at 11.5% at the end of August, or for the month of August. This is a good one for us. If you look at the targets the IMF has for us in terms of inflation, their target was around 12%, which means we are below that. For that of Goldman Sachs, at 10.8%, which means that we are yet to hit that target. We are all skeptical about this. We all have various views on this, but we are hoping that we are able to meet that target. For the Ministry of Finance, which had a target of 11.9%, and we've already gone below that. I'm sure they'll come up with a new revised target for the end of the year. And then BOG having the plus or minus 8, I think is something we should continue to monitor going forward. Now, the question again is going to be, what have been some of the major drivers of inflation? If you are looking at it year on year, we've seen that inflation have gone down. By year on year, we've seen that the drive is mainly by transportation. So we've seen that actually year on year, transportation has been down by a 5.2%. What accounted for that? We see what happened with our currency, and then we saw what happened with our fuel prices. That translated into the fares we've seen for our transport, and so we see that decline. So that's actually tells us something, that fuel prices actually is a major driver of our inflation. And so the fact that we've been able to get some strength for our currency, that translated into what we've seen for our currency, and then translated into the prices of fuel. We've seen that happen for the transport sector, which means that transport fares were down. But on this particular chart, one thing that is catching my attention again is the tariffs that the Ghana Water Company and then the ECG are trying to roll out, because they feel that is going to help them address some of the key challenges in that sector. Now, my question is, if we are seeing that year on year inflation for the house and water, electricity sector is still this high, with the tariffs they are going to impose, where is that going to put that number? And so we'll continue to monitor that trend as well. But month on month, when we are looking at this month on month, that is looking at July and August, what were some of the main drivers? So we see that transport actually was up by 1.90%. So we saw that even though in the previous month we saw fuel prices going down, we saw transportation fares going down, between the month of July and August, that wasn't the case. We saw a different trajectory for that as well. Then for insurance, insurance and financial services, we saw a decline in terms of the rates of inflation to that. And then we saw the largest here being food and non-food inflation, which is also one of the key drivers of inflation, seeing a decline by 2.50%. All this accounted for the drop we are seeing. But it looks like transport is actually one of the key things we should pay attention to. That's our fuel prices, our transport fares, being the major factors we should pay attention to going forward. Moving away from Ghana and then coming to the African landscape to see what's happening in Africa. We have seen sort of improvements on our space in Ghana, but what is happening when we look at like the whole kind of African continent as a whole, we are seeing the developments around Nigeria, which is our counterparty or our brothers on the other side, having their inflation at 20.12%. So you see their inflation remains elevated, which is mainly driven by high food and fuel costs. Even though they've actually announced some subsidy some time ago, they came back to remove those subsidies and actually accounting for the high food and fuel costs that we are seeing. We also saw their currency struggling, all translating into this high inflation. Nigeria is still having, South Africa as well having a 3%, but they have seen a stable inflation, which is actually anchored on the tight monetary policy. They are seeing moderating fuel prices and then the contained fuel inflation they've managed for some time now. Then for Kenya as well, which is one of the most upcoming, and then a country that is looking promising. People are monitoring it closely, for investors monitoring Kenya as a nation that they should possibly invest in. Inflation is being held in check by improved food supply and then government subsidies on key commodities. We've talked about GDP growth, we've talked about inflation. What does that mean, or what is the driving force behind this? Of course, we would have our central bank also this year doing quite well. For the past 7 to 8 months, they've been on their toes trying to address issues on the monetary side of the economy. Now, the question would be, they are sitting this week. Should we expect them to cut the rates? Should they maintain the rates, or should they increase the rate? I'm sure they're also going to look at their variables. They are going to look at the performance of currency. They are going to look at the performance of inflation, going to look at our GDP growth, and going to look at the fact that we will be having some tariffs being rolled out on electricity and water. I'm sure they'll factor all that in to decide whether to cut the rate to maintain it, or to even look at maybe increasing the rate. It will all go into their meeting this week, and so we'll also pay close attention to what's happening on that side. But so far, I would say the BOG have done a good work. So they've been able to reduce the money supply in the system, which is actually going to translate into what we are seeing with our inflation. So we had money supply at levels as high as 50%. They were able to control that, looking at where it started from the beginning of the year, around the 40-30 levels down to a 15.6% as at August. That looks like it's a good one for the economy, because they've been trying to use this policy tool to control inflation, and it has worked out in their benefits, and also in the benefits of the citizens at large. Now, what does that mean for the trend we are seeing here so far? It means that they've been able to also drop down the NPL rate to 25% as at August. That has also translated into the decline we've seen in the lending rates on the market, the GRR, to 19.67%. The government or the central bank is using the NPL as a tool to control inflation, money supply, and then also looking at how they can use that to control the overall economic stability. Now, they've been able to drop the GRR, or the GRR have also dropped to 19.67%, which is also going to be that the base lending rate for commercial banks in Ghana is also declining. That will serve as a reference point for us to determine where interest rates from banks would be on if you are trying to access a loan. And so looking at the rate cut so far, I think we started from 29, they came down to 28, and then we are down to 25%. They are sitting this week. We'll monitor to see what the outcome of that meeting is going to be. Now, coming to our fixed income space, where we look at the Treasury and the BOG auctions, the question I placed here once again is is government borrowing at sustainable rates? From the start of the year, we all saw the engagements from both the fiscal side and the monetary side, trying to address a lot of issues on our market, because they mentioned that they came to meet a lot of challenges with our economy. The government assured citizens they were not going to borrow at very high cost. And so we've seen that on the markets when I get to that slide. We've seen BOG also trying to mop up liquidity from the market, trying to make sure they control inflation to keep it at a very reasonable rate. Now, the question again is government borrowing at a lower cost, as we all have seen, sustainable? Would they be able to keep that going forward? So it's more like we have the fiscal side and the monetary side trying to roll out their policies. And so it's like at some point it looks like they are trying to agree on certain terms, and then at some point you see that they move away from each other, where we see monetary policy rate at 25%, and then we see treasury rate at this lower. We have 91-day rates closed the market at last week auction at 10.53. That's of 182 closing at 12.44, and then that's of 364 closing at 12.95. You look at the gap between the MPR and then the rates on the market, and it just looks like both the fiscal and then the monetary side are just trying to figure out how exactly they are going to manage the economy. But if you look at the trend, you see that anytime we have the rates come down and then the monetary policy rate is that high, we always return back to that levels where the government raises their rates back. And so the question I asked, if where they are borrowing now at these very low levels, we all agree this is good. It's a good thing for us. It reduces the debt accumulation for our nation. But would they be able to sustain it? Are we going to see rates going back to the 30s? Are we going to see the rates going back to the 20s? Because if you look at the trend, we always return back to that level. We'll come back, and then we have to go back to that high. And then here we are again. Here is the MPR, and then here is our rates. Are we going back to that level again? Now, as I mentioned before, that the government came into this particular administration with the objective of not borrowing at very high cost, because already we've accumulated a lot of debt on our books, and so they tried to borrow at very high cost, which means that already investors were not going to be happy with the rates at which they were borrowing. But investors as well would always see the positive and the negative side of everything, and so had the view that, okay, if they are borrowing at very low cost, what does that mean? It's sustainable. They'll be able to pay us our monies back. They wouldn't default on payments. Okay, so they still had some investors sending monies back to them. And so if you look at this trend, this chart here, they're showing us how much was tendered to the government against the targets and then accepted. So you see, week on week, government continues to reject bids on the market. And so if you see from January to September, as we've seen some quite some rejections from the government, just because they don't want to borrow at very high cost. You have investors tender their bids at very high rates, and the government slashes down, rejects some of these bids and just accept just a little up. So we've seen that on the government side, where they reject bids, trying to keep the rate low as well, just trying to manage the debt accumulation for the economy. And that's a good one. We give them a shout out for the good job they are doing on that side as well. Coming to the BOG auctions, right? We've seen some new introductions on this space, where we see the BOG introducing the 273 dated bill, all with the effort to mop up liquidity on the market. And so if you look at the trend, they've been mopping up quite a number they've been mopping up a lot on the market. We've seen a lot of banks going to them to tender in their bids. And so looking at the trend, even just for September, they've been able to mop around 5.5 billion on the market. But the interesting thing to see on this chart is where the rates dropped and what happened around those levels. So we see the rates hovering around the 27, the 28, and then somewhere in August, they came down to the 10.5. Now, the question is going to be, what was happening around that time? What was happening around those areas? Now, people feel that at that point, where the rates went that low, the banks, investors now moved a lot of money to the fiscal side. And so it looks like this time around, we are having the central bank and then the Ministry of Finance communicating with each other. And then it looks like this time around, they know what they are doing. And so you see the rates from the 10.5% move back to the 25%. Of course, if you see what happened with money supply as well, we see money supply come down that much. And so it looks like this effort is helping them. The rate went back to the 25 levels. And as at now, the rates are still in the 25% levels, helping them mop up some liquidity on the market, helping them address some of their policies and targets they've set for this year. Moving away from the auctions on the BOG side and the government side, we'll come to our equity market to see what's happening on the equity space as well, whether investors are taking opportunity of the current events on the equity space. It's been a good one for the equities market. And then the question again is if investors have gotten the return they were looking for this year on the equity space. So we see for this year, as we foreseen from the beginning of the year, it's been a positive one for the financial stocks that have returned 87.8%. And then the Ghana equities total returning 74.9%, and then the non-financial stocks returning 55.9%. For this indices actually is in-house indices, the financial stocks, looking at all financial stocks on the market, equally weighted. The Ghana equity total return also in-house those, looking at all the equities on the market, and then the non-financial classify just the non-financial stocks on the market, equally weighted. The indices actually takes into account the dividend payments on the stocks listed on the exchange. But when we look at the Ghana Stock Exchange Composite Index year to date, as at Friday, was doing 48.70%, and then the GSE fixed income or the financial stock index was doing 46.10%. So our indices actually takes into account equal weighted approach, also looking at rebalancing quarterly to adjust for issues of a stock being overweighted in the index, and also, as I mentioned, takes into account the dividend payment on some of the stocks. Looking at the performance of the non-financial stocks and then the financial stocks, I was just saying that we always say, okay, the financial stocks this year are outperforming the non-financial stocks. Let's break them down. Let's look at it year after year, quarter on quarter, what has been the performance. Now, if you look at it, it's been like if you were invested in our market or the stock market, you would have been making some good returns. And so our market is actually a good one. It's a positive one. We are seeing positive growth from our market. If you look at the greens on the board, more than the reds we've seen on the board. And so on 5-year average for Q1, you see a 7.4. For Q2, you see a 5.9, and then Q3, we are still in Q3, 8.14. The year hasn't ended, but if you look at the numbers we have so far on 5-year average, these financial stocks have returned 6.56%. Now you see 2023, we see some of the reds, and then coming to 2022, what's happened there? You see the financial stock for that particular year, 2023, fell by 7.36% overall. Markets, major banks like Cowbank, GCB, Societe Generale, EcoBank, Republic Bank, which are listed, also share prices decline from the range of 10% to 25%. MPO ratios also for that 2023 was very high at 20.7% from the 14.8 we saw in 2022. Some of the banks were still recovering from the 2022 GDP crisis, and so you see some of the reds in the 2023. Now, when we come to the non-financial stocks as well, as I mentioned, for the financial stocks, looks like our market is actually a good place to be invested. Of course, we've been having a conversation about geographical diversification, but it looks like our market is also a place where we can consider to put in some good investment. Now, looking at the non-financial stocks as well, you could see a lot of greens on the board for Q1, Q2, Q3. looking at 2021. So if you look at it, we've seen Q1 returning on an 5-year average 15.02%, Q2 returning 11.76%, Q3 on an average. So it's looking like it's a positive one for us. We'll see what the year ends with. So you see some reds on the board as well for 2022. What's happened there? For 2022, we saw a decline in many of the non-financial stocks. The broader market lost value. Many non-financial companies saw weak and negative returns. The reason were mostly macroeconomic, strong inflation, currency depreciation, tight monetary policy, high interest rates around those areas, fiscal pressures, and then a sort of investor weakness in the markets that mainly accounted for what we saw for 2022, where there are a lot of reds on the board. So coming to this year, looking at the year-to-date performance of some of the stocks on the board, it's been a very good one, as I mentioned, for the financial stocks. Most of them taking part in the BOG auctions, where they are offering very high rates, and so that also translates into the profits they've been posting on their quarterly reports. We've seen most of them post their annual reports, very good reports, quarterly reports, very good profits on their books. We can also say that investor confidence is beginning to build up, and so that's also accounting for some of the positive gains for some of these companies listed on the exchange. For SIC this year have returned to 288.9%. On the start of the year, we saw some change in leadership for SIC. I think that has also translated into the performance we are seeing for this year. But if you look across the board, it's been a good one for the financial stocks. I'm sure they are making a lot of good profits from the 25% rate they are getting on the BOG auction, which the ordinary investors are not able to take part in. Now, let's move away from the stock market and come to one of the interesting conversations that have been happening on our space in Ghana for some time now. That is the currency. I think from the start of the year, we've all been having this conversation around the currency. Where are we with our currency? The growth we've seen, is it something to write home about? Are we going to go back to the point where our cedi begins to depreciate again? We mentioned what are some of the driving forces that were driving the performance of the currency. And now looks like we are back to the point where we are seeing that decline in our currency. We saw it move to as high as 40% this year. And now where are we with our currency? So this chart is showing us what our currency have done this year. If you look at the dollar for this year, it's not been a good one for the dollar itself. It's down 10.08%. Our currency against the USD as at the close of Friday did 20.59%, which means that we've actually moved from the 40% we were having earlier this year to a 20.59%. So the questions that have been asked, what is now causing the depreciation we are seeing in the cedi? Against the pound also, we were up in the 30s, in the 20s. Now we are down to 11.03%. Against the euro also, we are now down to 6.24%. We are not in the negative, let's say, when I say we are down, but we are just comparing it to where we were and where we are now. We are actually depreciating against most of these our trading pairs. Have we seen a change in some of the fundamentals or key variables we were mentioning where the driving forces behind the appreciation we're seeing earlier this year? One was the gold reserves. Are we seeing our gold reserves going down? That is not what the chart, or that is not what the data is telling us. The data is telling us that actually we've seen a growth in our gold reserves in terms of net monthly additions. We've seen a growth. Looking at the chart from 2023, we went up, then we saw that decline, we went up again, and then we came slightly down. And then looking at this chart just for 2025, it's actually telling you that one of the factors we mentioned was driving our currency was our gold reserves. The chart is just showing us that the trajectory hasn't changed. We are still having our gold reserves going up. So what could possibly be the reason why our currency is moving down? This chart is showing us that gold prices is still going up. Gold reserves still going up, but our CD, which is the blue line, is coming down. And so what possibly could be the factor accounting for the depreciation we are seeing if our gold reserves are going up and then gold prices on the global space are also going up? It means that something is happening somewhere. If you look at our gross international reserves as well, if you look at the trend, it's been on that upward trend. If you look at from 2022 to the launch of the gold for oil, where we're trying to do some barter trade. We're trying to do some barter trade, trying to exchange gold for oil. I think that's accounted for the drop we saw in our gross international reserve. And then just coming into this new administration where they rolled out the gold board, and then also we saw efforts from the central bank. We've seen our gross international reserve climb up again. So that alone is something we were mentioning that was driving or was helping us maintain or stabilize our currency. That also hasn't changed. So this is just to give us over a short period what has been the trend. So we still see that our gross international reserves are still on that upward trend. On the global space, we still see that our currency is still doing well, regardless of the depreciation we've seen over the past month. So we still see Ghana coming second globally. If you are comparing the top performing currencies, we are doing 20.5%. And so question again would be, what is making our currency depreciate that much? Listening to the governor of the Bank of Ghana, he mentioned that the recent depreciation we are seeing with the cedi, let me borrow his word, is just a blip. And we are all hoping that what he said is true and that is just a blip. But the president last week met the media, and then he also mentioned that, I quote the president. And so, yes, the Bank of Ghana has been intervening in the forex market, but they have withdrawn. And what happened was that because of the rapid appreciation in the value of the cedi, we saw an exponential increase in imports, because then people could buy cheaper dollars and so they could import more, which is actually a natural economic phenomenon. But on the other side, exporters are not happy because they get fewer cedis for what they buy. And so from what the president said and from what we've seen, looks like the main or one of the key drivers of the appreciation was the central bank intervening in the market and supplying FX to the market. Now that they've withdrawn and they are not supplying a lot to the market, we are seeing that fall in our currency. Some people also argue about the fact that the IMF came some time ago to say we should stop interfering in the performance of our currency. And so people said, why should they tell us what to do with our own currency? Why should they tell us what to do with our currency? And so it looks like our government sort of is paying attention to what the external institutions are also saying, and so decided to withdraw and also address some of the issues that are coming because of the high appreciation we are seeing with the currency. Now, let's look at what the recent drop or weakening we are seeing with the cedi would mean for us. It means that there are going to be imports are going to be more expensive. We are going to see higher inflations beginning to chip in, and so inflation is going to be sticky along the trends going forward. Cost of living going high. We have rising external debt, and then the question here about external debt is going to be, when the currency appreciated, did we take advantage to clear some of our debt, or did we not take any advantage at all? We're just all jubilating our currency was appreciating. Did we make some good moves when our currency was up? Now that our currency is coming down as well, we are going to see some reduced investor confidence, and then we're also going to see pressure on reserves and the monetary policy. But on my mind, I want us to look at the positive side of a weaker dollar. a weaker cedi. So now we are saying that our cedi is coming down. It's not a good thing for us. The performance is not going to be a good thing for us. But can we look at what a weaker cedi could mean for us in a positive way? Because the president mentioned something about people not being happy about the prices they were getting for their goods. And so this weaker cedi we are getting now also is going to mean that what we are going to get some more expensive imports. And so imports, sorry. So I'm trying to look at the other side of this, right? Where I'm looking at what could possibly be the positive for a weaker dollar. I'm sure looking at the most we are getting our exports, where we see Ghanaian goods become cheaper abroad, rising demand for cocoa, gold, oil, and other exports, which means that we are going to get more FX inflows coming in, and then that will sort of translate into the growth we'll see for our economy. Also, it could mean that we are going to see support for our local industry, where expensive imports will now push consumers towards local goods, and so stronger domestic industries will now continue, will now begin to move, will now begin to see job creation in our space, will now begin to see SMEs begin to grow, all on the back of a weaker cedi. We'll also see maybe people abroad, friends and families abroad now begin to send in more money, because initially when they send in the money, they were complaining the value is no longer something to write home about. Now that we are beginning to see that drop in the performance of our currency, meaning that people will now begin to send their relatives some more cash or some more foreign currency, which means that we are going to get more effects coming into the country as well. And so these are some of the things we should be thinking about, some of the questions we need to be asking ourselves as we go through the year, as we look at the numbers changing month on month, and then we assess ourselves, we see where we are. These are some of the things we should pay attention to. Now, coming into the other side of the presentation, which is taking, treasury positions and then the recent views on treasuries on the market. Of course, we have all been arguing and discussing, sharing our views on what we think are the best alternatives to hold for our portfolios. Treasuries over the period have been one of the avenues that we have all taken position in. They've given us some good returns. And so I think majority of fund managers, majority of trustees, industry players, investors are exposed to treasuries on our space. But today we want to look at, okay, what have been the views so far? What does that mean for us as investors? Coming to why treasury bills even matter. Why treasury bills even matter in the current environment we find ourselves in. Of course, treasury bills, we all know, we have all paid attention to it. Treasuries offer some attractive yields on the market if you are trying to look at the trend over the period against some other asset classes. Treasuries continue to offer high yield if you are comparing it to even the rate or the yield savings provide you. In terms of liquidity also, you see that these are easily tradable. You see a lot of activities for treasury bills on the market, secondary market, a lot of volumes for that side as well. And then the benchmark rule. So you see the treasury bill rates on the markets generally serve as the pricing for other instruments on the market. And so if you see people coming to the market in terms of trying to issue some debt instrument on the market, you always see them factor in some of the yields on the treasury bill market, and so gives you that comfort. Also, we have the risk return balance, where you have that confidence that it is a low risk investment to be looking at, giving you fair returns. The fact that it's the probability that the government is going to return your money to you is very high, and so consider it to be very low in terms of risks. Also, we cannot look at it without looking at the risks, and so would have credit and rollover risks, would have duration and reinvestment risks, opportunities from yield movements, and then macro movements. So treasury bills can carry some risks, as we all know. We've over the years talked about it to be risk free, but there could be some risks that come with it in terms of credit and rollover risk. And so government repayments and reinvestment at maturity. So you are looking at, okay, what if my money does not come on time for me to roll over? What if I miss out on some good opportunities on the market, or that being a risk for you? And then a duration, also looking at locking in on some good rates when the rates are low, when the rates are high. So you look at in terms of duration and investment rates, values, look at our value and return before if interest rate change. In terms of opportunities from yield movement, also you look at earning more when the rates rise or holding value when rates fall. And then also you could see that the rates we see on our space is mostly driven by economic policies, maybe some issues coming with restructuring of some debt. All this could shape the direction of the treasury bill rates and then the treasury bill market as well. So those are some of the rates that are associated with the treasury bill space if you are looking at taking positions in that. Now, let's narrow the conversation down to Ghana. So the Ghana case for treasuries. We've actually operated in a very high rate regime. And so from the mid 2017, where we see the banking crisis and loss of confidence, what does this mean? Where did they push the rates? Push the rates up, created volatility. And so what this means is that when the banks are weak or people fear for the banking system, the risk premium would go up. Investors would demand higher rates for short-term government debt. Now we come to, if you look at coming to early 2022, where we are having inflation, we're having currency weakness, debt concerns, rising global interest rates. Globally, inflation around that time was rising. Locally, the city was also not doing well. Debt service burden were rising, causing risks to increase, and then the government ability to borrow on the market domestically and then external was under sort of some constraint. And so these factors were going to push government to want to raise, to increase the rate to entice people to come and give money to the government. We move away from that, going to the late 2022 to the early 2023, where we see the sovereign default, debt restructuring, IMF bailout. Default risks was all over the place, where investors demand very high yields on T-bills due to the risks of non-payment or restructuring. Additionally, inflation was still high and borrowing costs globally was still high. And so all this pushing our inflation, our rates high. Coming into the mid 2025 or entering into the 2025, where we are seeing the fiscal stabilization and then declining inflation, policy rates cut, debt relief measures being rolled out. Inflation is now coming down. Central bank efforts now putting rates down and then reducing the yield benchmark, better debt management, bringing the rates down to the 12%, 10% as we see now. Looks like we are having a new narrative coming into play. But when the rates were high, did we have fund managers, trustees, investors taking advantage of this high yield on the treasury bill space? Of course, if you are looking at the pension funds AUM allocation to GOG bills, largely treasury bills, it has been the same trend over the period where we have from 2021. You see the exposure to treasury bills very high. You see 2022 exposure to bills, government securities very high, 2023 same, 2024 same. And so it looks like we're locking in on the high rates regimes and then we're locking in, taking advantage of the high rates. And so it looks like our market actually was offering very good rates and then investors were locking in on that. Fund managers took advantage. We see mutual funds and the money market funds also capitalize on these high rates environments. And so if you are looking at it for Q2 2024, most of the money markets, mutual and money market funds having very high performance. But if you come down to what's happening this time around, where the rates have gone down, you see that majority of the funds this year are not really seeing a stable performance as compared to what we were seeing when the rates were that high. And then you could also see that the ones that are performing this year are actually holding on to some of the bonds they were holding. And so they are not solely exposed to the bills they are holding in some bonds, which is actually driving some of the good performance they are seeing this year. But if you look at it on an average, you could see that when the rates were very high, they were making very good returns as compared to now. But the rates were very high, the yields were attractive, fund managers were locking in, pension funds were taking advantage. But we always forget to look at what that means for the debt we are accumulating. So if you are looking at just the maturity profile for the treasury bill space, you could see that from 2023, we were actually accumulating a lot of debt coming to the 2025. And then now it looks like the rate at which we are accumulating the debt is now coming to, it's now at a slower pace because of the new government we have, the new policies they are rolling out, trying to bring down the debt burden. Looks like they are now bringing that down. And we've seen that with the rate. So it looks like now taking positions in treasury now looks more sustainable than before. The treasury bill market continues to post strong performance if you are looking at it over a long period of time. This chart is showing us from December 2012 till now. You are looking at the performance, showing you that the treasury bill market have actually been outperforming even the equity total return, which is in-house, and the Ghana Treasury Index, which is also in-house built. So it looks like over the period, investors have been tilted towards the treasury bill market where they get a lot of return, good returns from that side. And so it looks like in diversifying your portfolio, the treasury bill market in Ghana is an alternative, is an option to consider. But if you are looking at it on a very short period of time from 2023 December till now, what are we seeing? We are seeing a different story here where we are seeing the equity space beginning to outperform the treasury bill space. So like I mentioned, you see the rates coming down now because government is trying to control the cost at which they borrow. What that meant, or what that means for us, is that investors are now looking for where they can get a very positive return on their investment. And so you see a lot of people now moving towards the equities. And of course, the equities are now showing that they are giving very good returns with what I mentioned with the financial stocks earlier in the presentation, that they are taking advantage of what's happening on the BOG auctions, locking in on some good 25, 26 rates on that side. And then it's favoring most of them. And so you see most people now taking advantage of the equities. And then we see the treasuries now where they are assets now because the rates are not attractive, but it's something to consider over a long period of time. Treasuries will be an alternative to factor in your portfolios. So if you are concerned about liquidity, if I'm going to the treasury bill market, if I want to take some positions in treasuries, am I going to see with a lot of trading? Can I easily sell and get buy, sell, get my cash? Is it possible? Yes, if you look at the chart, it tells you that there's actually a lot of trading volumes that are happening for treasury bills on the market over the period. If you look at from 2016, look at the trend, it's just been an upward trend that we are seeing for the secondary trading volumes for the T-bills. And so for liquidity needs, it's not an issue if you're considering treasury bills. Now, post-DDP, we've seen the market trying to realign in terms of the yield curve. Now, post-DDP, we've seen the interest rate, which is in the green, trying to align where we see investors actually getting the right compensation they should be getting for their investment. So over the long period of time, you are getting a better interest rate as compared to the shorter dated investments. But if you look at pre-DDP, it looks like our yield curve was actually the other way around, where people invested in the shorter tenors were actually getting very high rates compared to people who were investing in the long end. And so the narrative is changing here, where we are saying that now the yield curve is beginning to align, where we see investments within the shorter tenors actually getting what rate they should be compensated with. And then we see people or investors on the long end getting the high yields. And so the yield curve will actually align as the market conditions continue to change. And so it looks like our market is actually trying to conform to the dynamics in the market. And so it's a good one if you are looking at the treasuries on the market. It's a good one for you to look at this as well. Now, we cannot conclude the conversation without looking at geographical diversification. We cannot just be looking at Ghana alone, but it would be good we look outside of Ghana to see where there are some opportunities. Opportunities are always outside of our space, and then it is good for us to look outside our space sometimes to see where the opportunities are. And so this morning we just want to look at what's happening outside of Ghana as well. But before that, we would want to sort of get some color on what's happening on the US market as well, because globally we've all been looking out to the United States as a benchmark for most countries. They've also seen their Fed rates for some time now been stable at 4.33%. The President Donald Trump has sort of been mounting some pressures on the Fed chair to cut the rate because he feels that it's good for business and that is good to revive the economy. But the Fed chair also mentioned that they are looking at a basket of items. They are looking at where inflation is. They are looking at the geopolitical tensions around them. They are looking at their job numbers. And then they feel like they need to really assess the impact of all this before they can cut the policy rate. Their inflation also being sticky, up and down, up and down. And so it's a trend that their central bank is also monitoring closely to see how they are able to factor all this into the dynamics that are playing on the market before they move ahead to cut the rate. But investors are already pricing in rate cuts and then making decisions based on this, looking at bond prices, looking at the yields on the market to see where the opportunities, like where the good yields will be for them to take advantage of. And so if you are looking at taking positions in the United States, then you'll be looking at the key economic happenings on that space as well. Of course, if you look at the debt for the United States as well, it's looking like it's been growing for some time now. And then initially, or from the beginning of Trump's administration, he mentioned that the debt that the United States was accumulating was just too much for them. Some not necessarily that they have accumulated by themselves, but just because of their services they were extending to other countries. He mentioned that he was going to cut down a lot of their deficits or a lot of their debt numbers. He was going to try to cut them down highly. And so we saw the rollout of the tariffs on their trading counterparts. We also have some hitting Ghana as well. And so it's looking like Ghana, as I mentioned, trying to manage their debt burden, trying to cut down their cost. The United States as well is doing the same thing where it's trying to bring down its debt levels. And so they are all trying to manage their debt numbers. Now, you see that translate into their yields on the market where you see 13-week bill rates on the markets coming down. If you look at the trend, they've all been in that same trajectory, trying to price in the rate cut expectations as well. And then looking at some of the numbers, people would want to see, okay, where would I get a possible sort of attractive yield on the market? Should I be looking at the bond market? Should I be looking at the US Treasury market? Because they've seen the yields on that side come down for the 26-day as well, or 52-day as well. We've seen them come down as well because there's a lot of dynamics playing on the markets around the inflation numbers, the happenings on the stock market, the happenings with their policy rates, the Fed cuts, all that's been factoring into this. For long-term yields as well, we've seen it decline for 10-year yield as well. We've seen it decline to 4.06%, 5-year decline to 3.63%, and then that of the 3-year also declined to 3.52% for the US Treasury market. If everything plays out, if their currency begins to pick up, if inflation begins to drop, they have the view on their employment numbers where they say their employment numbers are not looking good. But when things begin to align, when things begin to look good, where are these yields going to be when the Fed cuts the rate? what is that going to mean for their treasury rates on the market? What is it going to be for their bond market? And so all that are dynamics, all that are key variables that we need to be paying attention to make some of the decisions. Treasury bill, of course, if you look at the trend over the period, have been stable, have been giving investors some positive return, all this showing performance from the beginning of the year. So now Treasury bills returning 3.06%, Treasury bonds and note doing 5.60%, and then equities for the US market did 12.98%. They struggled somewhere this year when the tariffs were rolled out. We saw the equities market suffer that much, but for equities, it's been a stable performance for the US Treasuries. And so if you are hoping to diversify and you're hoping to have a very stable, not so much volatility in your portfolio and looking at where to sort of consider geographical diversification, US Treasury bills, of course, will give you some alternative. Now, you're hoping not to get so much exposure to um, dollar. And so you'll be looking at, okay, what is the the quality of the underlying securities. And so you are considering, okay, here in Ghana, if I want to get exposure to treasuries, where do I look at? You can look at some mutual funds that invest in US treasuries. You can look at some good ETFs that invest in some US treasuries. And so, for instance, our in-house fund, Delta Fund, which solely focus on US treasuries, gives you that exposure. Now, just looking at the comparative sort of perspective, where you're looking at the Treasury Bill Index and then also looking at the Ghana Treasury Index, all this performance showing in CD, you can see that over a long period of time, we've seen the Ghana Treasury Index outperforming the US Treasury Index. Often the drag here is because of currency, because if you see what happened in the 2022s where we saw currency doing its thing, we saw that decline in the US Treasury bill index if you invested in it. But it's looking like for our index, the Treasury index for Ghana have been stable. And so it's looking like the return for investors just solely holding on to Ghana Treasuries was very good over the period. But let's zoom in and see what would happen if their dollar or their currency also begins to pick up. It's down 10%. What if it climbs up? What if it gets back into the positive? And with what we are seeing it with our currency also depreciating, the president mentioned that he is looking at a 5% depreciation for the currency, the CD, every year. So what if that happens? Meaning that the Treasury bill index or the US Treasury market would have given you some good returns. Even if you are just accounting for just that 5% depreciation every year, you would have sort of gotten some good returns for your investment in the Treasury space. And so if you are considering geographical diversification, you want to look at the US Treasuries, it's a good one to monitor going forward. And so for me, I'm going to end my presentation today just saying that Treasuries, of course, remain a complementary asset class for portfolio diversification. If you are looking at limiting your risk exposure, you're looking at reducing volatility, you're looking at where you can get some stable returns, looking at some good rates and not have to invest your money and be worrying about if I'm going to get my money at all. If you're also worried about liquidity, can I easily sell? Can I easily buy? Can I easily get my cash back to do other investments? I think Treasury is just the best place to consider as a portfolio manager, an investor, industry player. Is just a good one. And so I would end my presentation here. Let's have a good conversation. Let's all discuss. Let's all share our views on some of these things from currency, from stock market. What do you think is really happening in Ghana? What should we pay more attention to? Thank you.
All right, thank you very much, Justice. That was quite insightful. I'm sure probably some of us will have questions, and it's it's very warranted. In his presentation, I'm sure he mentioned a few things which caught people's attention, and Over the past few months, I'm sure the conversation about negative returns and real returns have actually died out because now inflation has come down all the way to 11.5%. And I think it's also a very good time for us to pay attention to treasuries because not just about currency, but protecting our daily income. Before I open the room for questions, I would like to launch a few polls and then we can have a conversation. Okay, so to the first poll, what's your general view on the state of the economy based on the current macro trends? I think Justice shared a few insights about the economy, and we could all see it's picking up. What's your general view of it? Moving on to the next, do you expect the macroeconomic environment to improve further in the coming months? If yes, do you think it's going to be significant? Is it going to be modest, or it will remain flat, or probably it will worsen, especially now that our currency has started depreciating against the major trading currencies? What do you think? In case you did miss the previous poll, you can find it in our chat box. Now, to the third one, what do you think the major factor behind the recent depreciation of the CD is? Will you attribute it to high import demand, external debt pressures, speculation, and fiscal deficits? Bank of Ghana's reduced intervention in the FX market? If you think it's something else, you might also add it in the chat box. The fourth one, do you think the Bank of Ghana should consider a rate cut or a hike, given inflation trends and possible tariff adjustments for electricity and water? So we know that they're sitting this week, and then by Wednesday they should come up with a decision. Do you think they should hike or cut? And I think from one of the charts also that Justice shared, year-on-year inflation, when you look at the other variables, it's just transport that was down. The rest were also increasing from food, beverages to oils. So do you think inflationary pressure still exists? And if so, should Bank of Ghana react by hiking? All right, so our fifth poll. Apart from treasuries, which other asset class would you consider attractive for firm portfolio returns? In the second one, with the president forecasting a 5% depreciation of the CD, do you consider foreign investments a good hedge for FX? In as much as would agree we would want to protect our income against inflation, do you think foreign investments is also good for FX hedging, especially now that we are calling for diversification? To the last question, what one word comes to mind, given the rise in fintech platforms, making it easier to buy treasuries in Ghana and abroad? What word comes to mind? The first word that comes to mind. You can type your response in there and then submit. All right, thank you very much. That will be the end of the poll. And at this point, I'd open the floor for questions. Please, if you do have any questions, you can raise up your hand. I'll do allow your mic, and then you can speak. In the case where you cannot speak also, you can do type your question in the chat box. I'll do read it out, and then the presenter will attempt to answer it. Thank you very much.
Yeah, I think if there are no questions, we should have more of a feedback, what people think on some of these issues that are happening in our space, from the rate on the market, on the BOG auction, to the treasury market, to FX. What do you think? What are their views? Are they getting FX on the market when you go? Are you getting when you are looking for dollar these days? Are you getting looking at what the government is saying that is a reason for the depreciation we are seeing? It's just a blip. We should expect a 5% depreciation every year. I think people should feel free to air their views on some of these things.
Well, probably put your thoughts together. I'd like to remind us that at Black Star, we are your house for all sorts of investment when it comes to investment advice. Our team is well and able, is also equipped to be able to facilitate these decisions also for you. When it comes to capital raising, our investment banking team has its doors open to assist. And for our brokerage arm, when it comes to anything, treasury bills, we spoke about treasury today. Treasury bills, whether onshore, offshore, for your settlement of any fixed income security, you can contact them. They are your one-stop brokerage firm. For our asset management wing also, I think during the call, Justice mentioned that we did have a mutual fund called the Delta Fund. This fund looks at US Treasuries also, and it will be a very good hedge against FX. There are already people who are taking advantage of it. And I think after this call, we should also look at that. You can also visit our website, blackstargroup.ai, for more information on our funds. We have other equally exposed